Welcome back to the GMS Weekly Ship Recycling Market Insight Podcast, your short take on the world's largest cash buyer's view of recycling markets. It's week 49 of 2025, and I'm Ingrid.
And I am Henning. As we move into the final weeks of the year, the recycling markets are feeling the usual festive slowdown. Supply remains thin, fundamentals have weakened a little, and most buyers are wrapping up a year that's been long on patience and short on tonnage.
The broader market picture tells the story. The Baltic Dry Index fell by about 3% this week. Capes were down roughly 4.4%, Panamaxes off about 1.4%, and the smaller segments shed a few basis points too.
Oil prices hardly moved, closing around $59.70 a barrel, with talk that they may finally nudge above $60 in the days ahead. Inflation numbers showed slight improvement in some destinations, but currencies were where the real trouble lay.
Both India and Bangladesh saw their currencies weaken against the US dollar, while Turkey kept its unfortunate spot among the top 3 global underperformers. Add in falling local steel prices, down by just under $5 per ton across the subcontinent, and you've got buyers taking a step back as the week closed.
And with freight earnings still at healthy levels, there's no rush to scrap. Around 15 large LNGs have been committed for recycling so far this year, but even that stream has slowed to a trickle. This week, the beaches were almost deserted, with virtually no new arrivals at any of the major recycling destinations.
There is some good structural news, though. Since the Hong Kong Convention came into force in June, the region has seen steady progress. 23 yards across the Indian subcontinent have now achieved HKC certification in 2025 alone, including Pakistan's very first approved yard in Gadani, which was confirmed last week.
So even in a quiet market, investment in environmental and safety standards continues. Looking back, this year will likely be remembered as the cherry of the past 4. Better than the post-pandemic slump, but far from the boom years. The hope now is that 2026 brings steadier fundamentals and, most importantly, more tonnage.
Let's start our regional look with Bangladesh.
After a busy November, Bangladesh has hit pause. Most active yards in Chattogram secured at least 1 unit last month, including several large LNGs. Now, the market has cooled considerably. The Bangladeshi taka weakened by about 35 basis points to 122.35 to the dollar, and local steel plate prices slipped by $5 to about $502 per ton.
With those fundamentals softening, there were no fresh sales or arrivals this week, just vessels already on their way being beached. The real bright spot remains regulatory. Since March, 22 yards have achieved Hong Kong Convention approval, a major leap forward in less than a year.
Economically, inflation is still hovering around 8%, and the interim government is expected to hand over after elections in early 2026. So for now, recyclers will keep themselves occupied processing recently delivered tonnage while waiting for more stability.
Moving west to India, LNG continues to sit at the bottom of the subcontinent price table. Freight markets are still strong, sanctions have tied up more ships, and very few vessels are heading for recycling. This week, not a single new arrival was reported.
The numbers haven't helped either. The Indian rupee fell again, down about 70 basis points to 89.96 to the dollar, while domestic steel plate prices eased to around $387 per ton. It's a difficult mix for end buyers trying to price new deals.
It's worth remembering that India remains the most mature Hong Kong Convention story, with many along yards having been compliant for nearly a decade. But that advantage doesn't translate into pricing power when currencies and steel are weak, so Indian recyclers are playing defense for now.
Pakistan continues to build momentum on the compliance front, following the confirmation of its first HKC-approved yard in Gadani last week, a milestone that's now inspiring more yards to pursue approval.
Beyond that milestone, the market stayed subdued. Gadani's anchorage has been empty for almost a month, and fundamentals slipped further. Local steel plate prices dropped another $5 to about $575 per ton, pressured by cheaper Iranian imports.
The Pakistani rupee actually strengthened a bit, closing the week at 280.42 to the dollar, but it wasn't enough to lift sentiment. With limited HKC capacity and scarce supply, recyclers are mostly focused on upgrading their yards and waiting for new candidates to appear.
And finally, Turkey. Aliaga has enjoyed a modest rebound, with both imported and local steel prices rising by about $10 per ton. Offers for incoming vessels improved by a similar amount across the board.
Indicative levels now stand around $270 per light displacement ton for bulkers, $280 for tankers, and $290 for containers. That's still well below subcontinent pricing, but the gap has narrowed slightly.
The challenge remains the lira, which slid again to about 42.55 against the dollar. Despite talk of new economic support measures, currency volatility continues to make life unpredictable for Turkish recyclers.
Putting it all together, the GMS rankings this week keep Bangladesh in the lead, with bulkers at roughly $410 per light displacement ton, tankers at $430, and containers at $440.
Pakistan follows at about $400, $420, and $430 respectively. India trails with $380, $400, and $410. And Turkey rounds things out in the high 200s.
Those are, of course, indicative numbers in an extremely quiet market. With so few ships changing hands, sentiment can swing quickly on even a single deal.
So as the year winds down, the market sits in a holding pattern, steel a touch softer, currencies volatile, Hong Kong convention compliance advancing, and supply still stubbornly low.
End buyers are being selective, owners are content to keep trading, and everyone's watching for signs of a livelier start to 2026.
That's it for this week's GMS Weekly Ship Recycling Market Insight. For the full written report with tables and port positions, download it directly from the GMS app or our website.
Thanks for listening, stay safe, and we'll catch you again next week with another market update.